So okay, I think we have a good amount of participants who have joined the meeting. Looking at it, we are standing at 54. I think that's above the task quorum in the new proposed constitution. And I think we can start off. Hopefully everyone is okay. Thank you for joining us for this webinar on fixing motor insurance in Kenya. Just as a general rules of engagement, I think this is one of the best audience we've received who attended task webinar. So we'd like to hear from you. We'd like to see your engagement. So feel free to drop questions on the chat box on the Q&A panel platform. And also we have a one question survey. Let me confirm if you can see it. Sheila, kindly confirm you can see the metimeter survey.
Where?
Can you see it?
No.
Okay, let me fix that. So as it comes up, I'd like to introduce our panelists today. Just to mention, we have quite some big heavyweights from the industry, starting with the regional CEO of Britam, that is Jackson Deuri. Jackson, you can say hi.
Good evening.
Thank you, Jackson. Jackson is in charge of over 7 countries. So you best believe we have the best. Secondly, I'd like to introduce James Wambugu, the co-founder of Sovit, with over decades of experience and served as the former MD for UAP GI. So say hi, James.
Hello, everyone. Very happy to be here this evening.
Thank you, James. Thirdly, we have Sheila Kirika, an actuarial manager at Old Mutual, in charge of 7 countries also across Africa, with a wealth of experience in the industry, and also somebody who have had speak passionately on some of this on the topic today. Kindly say hi, Sheila.
Hello, everyone. I hope you're well, and I'm looking forward to this conversation.
Thank you. Then finally, but since not the least, we have Jay Koskei, a principal actuary at Zamara and the head of actuarial services at Zamara. Also a task council member, I think the treasurer, James, Jay. Kindly say hi.
Good evening all. Thank you, Kevin, and glad to be here.
Thank you. So I don't know if my survey is on the screen. Kindly confirm, Sheila.
No.
Okay. One more. Just a minute. So as I set it up, what about now, Sheila?
Finally, it's up.
Oh, perfect. So we would like the audience participation on this question. It's a simple question, just to find out what the audience thinks is the biggest challenge of facing motor insurance in Kenya, with the options being high claim frequency, fraud and inflated claims, underpricing and unfair competition, and low customer trust. I think, Catherine, you can help me share the link to the survey on the chat box, and also in case you're on your phone, you can scan the QR code on the screen. So as the participants votes, I think we can start off with just a quick round of opening remarks from the panelists. I'll start off with Jackson. Maybe you can help us understand where the motor insurance industry in Kenya stands, being that you're from Britam and it's one of the biggest players in the market.
Okay, interesting. So I'll try and summarize it and say one, motor is, I would say now, the second largest. It used to be the biggest for a long time, but I think it's been overtaken by health. Like in most developing countries, motor insurance is actually one of the larger classes of insurance. And the reason behind it is part of the motor insurance, which is third party, is actually compulsory. So it is the largest or one of the largest by market share, but unfortunately also leads on the loss side. So insurers today don't make money from motor, and that has been the case for over a decade now. So important class, clearly needs driven, the most common class of insurance. Most people engage with insurance in our markets for the first time through motor insurance, but unfortunately the insurers lose money on it. I think that's really the high level comments I can make about motor insurance.
Okay, thank you, Jackson. So I think you've captured it well. One of the reasons for the webinar today is that motor insurance, we've seen several developments recently. I think we can all agree last month in August, we saw a spike in motor accidents in Kenya. And a story that never hits the headlines is the long compensation process. With Sheila here today, she'll be able to help us. She has a solution to help us tackle that. Another reason for the webinar today would be last year, I think in December, we heard from the MP from Langata, that is Jalango. He was proposing making third-party motor insurance optional and not compulsory in the country. So with the panelists here, they'll help us understand what this would mean to the industry and how better we can prepare as motor insurers, the motor underwriters in Kenya. So quick results from the survey. I see the leading vote getter is fraud and inflated claims. I'd like to welcome James, maybe to have a comment on, given the emerging technology and the large amount of data that we are seeing today, how can underwriters or motor insurers use technology to help guard against this insurance fraud?
Thank you very much, Kevin, and good evening, everyone. Let me even start by, where Jackson stopped, in terms of the maturity of our motor insurance in Kenya. I would say, actually, we're doing, by the comparison of our peers, and I think it's not very good to keep comparing ourselves with the dwarfs, but by comparing with our peers, we're doing quite well. We have a huge percentage of comprehensively insured vehicles compared with all the countries in Africa. You might be surprised that the number of comprehensively insured vehicles in Kenya are way more than in say Nigeria, which is a huge economy. I was thinking about it, and I compared it with the experience we have had recently with our football, that we presented a better picture of ourselves as a footballing nation than we really are, because of how Chan was done in Kenya. So we have potential to be better, because number one, I think the number of cars that are comprehensively insured are reducing. And I hope that we will also have to address that in this. And specifically, you're asking me, how do we use technology to deal with this question of fraud? And I can see, as you said, everyone thinks fraud is a fundamental problem. And why is it a fundamental problem? Because of a few people, because you'd be surprised, I would imagine, out of 100% of the people we insure, maybe only 5% really intend or even get involved in fraud. Unfortunately, insurance being a business of numbers, what you're going to find is that 5% wipe out most of the profits that the insurance companies will be making. And therefore, then what tends to happen is insurance companies put so many roadblocks to people insuring, people experiencing better customer experience because everyone is treated as a suspect. And as a result, the experience is not good. So the numbers that are being insured keeps dropping, and therefore the pool from which you pay claims keeps reducing. And as a result, we're staring at going backwards instead of going forwards. Now, if you want to talk about technology in trying to address fraud, I think you have to first of all ask how does fraud then get perpetrated? And fraud comes in at two stages. The first stage is at the point of entry of the asset into insurance. That is when you underwrite a vehicle. Unfortunately, the experience and the way people have been handling insurance companies, the insurance professionals who are running insurance business, they actually don't think so much about this. The second stage is when, of course, a claim occurs and the claims gets exaggerated, and that might be significant, but I believe that so often the claim itself is premeditated, and therefore the best place at which you can actually be able to prevent is at the point of entry. Now, how can you use technology? Now, the way to do it is at the point of entry, you need to prove three things. Two of them are critical. First, does the vehicle exist? Because today, someone can come and insure a motor vehicle, and the vehicle does not exist. After a few months, make a claim of theft, and it's so hard to prove that the vehicle did not exist if you didn't carry out any tests at the beginning. Number two, what is the condition of the vehicle? Because sometimes the vehicle may exist, but may be already damaged. And if you, in fact, recently from Solvit, we did help one of the insurance companies where someone had tried to bring two cars. One was okay, so the photos that were taken were for the right car. I mean, for the car that didn't have damage, but the car that was being insured, the car had damages. And because of the technology we use, it was possible to show that the photos were all taken from different locations because technology is able to locate where the photos are taken. And using that, basically, it was easy to bust these people who were trying to perpetrate fraud. So you need to establish existence. You need to establish the condition. The value of the vehicle is not such a big problem usually because even, for example, if you ask me today, if I go to the database of Solvit, or if you go to the database of any insurance company and you give me a Toyota, a Leon, there's a range within which, if you give me a value that is way beyond I'm likely to say no. And in any case, when an accident happens, you always do pre-accident valuation. So therefore, those first 2 points are very important. And how can you be able to deal with it? Let me give you the example of the thought process that we did at Solvit. And I was really wishing that the person who should have been sitting here talking this way now would have been the MD of Solvit, Martin. But because I've been involved in the thinking of establishing Solvit, I can talk about it. And it was one of the big things that we thought about. So what we do is, number one, we ensure that the time between when a car is coming on cover and when valuation is done, it can be as short as 2 hours, which means you remove opportunity for manipulation. Number two, we send people to where customers are to create convenience. And number three, we use technology such that the photographs we take are both date, time, and location stamped, so that if, for example, someone tries to bring another vehicle, there will be a bit of a challenge to be able to do that. And number four, those same photos, we insist on taking photographs of photographs of data points that are difficult to manipulate. For example, you have to take a photograph of the vehicle chassis number on the chassis itself. Now, our solvers on the ground are trained how to find that. And therefore, at the end of the day, you are certain that the vehicle was at the location that is claimed, the vehicle is the actual vehicle and at the time. So if your cover commences at a particular time, it's not possible for someone to front date or backdate backdate that using by just looking at the report from Solvit, and you can be able to do that. I think the other way of using technology is building a database within the industry. And I think this is so important. I know we do have that where, and it needs to be comprehensive, where all the vehicles that are insured are actually in that database. All the vehicles that have had a claim are in that database. All the vehicles that have been written off are in that database, and that database should be available to all those who subscribed their data there. And what will then happen is that before you go on cover, you actually check that. Now, when it comes to the because I know I'm taking a bit of time, when it comes to the other side of processing the claim, usually the fraud is perpetrated when you create too much time between when an accident happens and when the first piece of information is received and when an assessor is sent and when the claim is paid. The story between when an accident happens and when actual payment is done can change materially. I understand that people even have damaged parts that for different cars that they can lend out to garages, so that when assessor comes due to collision with maybe the agent, maybe a staff member in the insurance company, the garage, and the assessor, a vehicle that only required a replacement of a bumper, it literally has, the claim moves from 100,000 shillings claim maybe to about 1 million shillings claim. So what we do is, if you can be able to find a way in which you collect data immediately a claim happens. For example, you can ask the client to take photos immediately. You can add and then encourage them by telling them, if you do this quickly, then your claim will be processed faster because there's less suspicion. Or you can use a service of those people who can get on site. Now, Solvit normally does get on site because we have people spread across the country. We have solvers spread across the country. As soon as an accident happens, there can be someone there within 30 minutes. That's the timeline that we provide. Then they collect the information. They take the statement. They feed in more, essentially collect information that you do not then need to ask for a claim form. And then they take photographs of the accident scene, of the damages. Once you have that, it is possible that actually 50% of your claims you do not need to then subsequently ask for an assessor. Assessors will only be needed where there are significant damages. So we're not thinking of some crazy kind of technology. It's just what creates that confidence that what is being presented is the truth, and what also ensures that the speed at which information is collected is fast. I hope it does make sense, and I think the people in leading insurance companies, and especially people in the middle levels, they need to believe in this thing because they do not seem to believe in it. While their bosses do seem to agree, people in the middle, or people who actually make the decision as to how we process the claim, the speed at which they do things actually introduces opportunities for fraudsters. I think I'll stop there, and I'm sorry, I know I've taken a bit of time, but it's the only opportunity I have to really talk about something that I feel is very passionate in my mind.
That's okay, James. You put it quite well. Yeah, you said it quite eloquently and passionately on how we're using technology. I love your statement on giving confidence, both on the client level and also on the insurance level. Maybe James Jackson, you can expand even further on how maybe underwriters, the motor underwriters, can move just beyond the vehicle value and type as the way of risk profiling and pricing.
Thank you, Kevin. I think that's an interesting question. I think one, it's time we move from looking at just to risk factors to price motor vehicle insurance, because the practice of just using the motor value and the motor type, the challenge is that then the good drivers subsidize the bad drivers, and no one really benefits from good driving. So I see there being a need for us to move to a more dynamic pricing that looks at several factors. So effectively, we need to do what is called micro-segmentation of our customers rather than general pricing. What it means is that we look at three broad things. Who is the driver? Secondly, so on the driver, you're looking at the profile of the driver, their driving history, their where they drive, when they drive, the driver's age, and several other factors around the driver themselves. Two, we need to think about where does that person drive. So the location, because where you drive also indicates the likelihood of you having an accident. So you might be a good driver, but if you drive in areas that have a black spot, for example, or whatever or times when accidents are more likely to happen or not, then the likelihood of you having an accident becomes higher. And then the last broad area is around the asset itself. What type of vehicle, what is the cost of the vehicle, what model, how old is it? So effectively, what I'm advocating for is that we need to increase the data points so that we are not just using one or two factors. And the more data we collect, then it means we'll be better at doing what I'd call personalized pricing. Now, to be able to do that, there are three things. There are three foundational things that we as insurers need to put in place. One is around the people we have, people and culture. So around the people is what skills do our people have? Do they have the data, the relevant data or actuarial skills to do that? The culture, are we a data-driven industry or organization? And do we use that data then to make decisions? So around the people and culture is around the people themselves, their skills, their experience, qualifications, and then the culture within which we manage them. The second one is the technology. As I've said, you need to collect much more data for you to be able to make pricing decisions. So the technology we need today needs to be more agile. It needs to be more dynamic. It needs to enable us collect additional information as the world evolves, because the world is evolving. A good example is right now, all over the world, the proportion of electric vehicles is increasing compared to your traditional fossil fuel powered vehicles. That's a new dynamic that maybe if one was pricing 10 years ago, they would not even have thought of. So how agile is the technology? So I'm not saying we must have the technology that serves all our future needs now. It means that we must be able to modify our technology as the world evolves. The last ingredient, which is foundational, again, is the process we follow. So how do we govern this data once you get it? Collect the right data, analyze it. How frequently do you analyze it? How then do we use that data to make pricing decisions and personalize our servicing to our customers? So I know I've given you a bit of a mouthful, but what I'm advocating for is us moving from basics to a bit more advanced, and I see it being a journey. If I was a new insurer setting up today, I'll set up with perfect systems. If I'm an existing insurer, it doesn't mean I say I don't have this data. There's always a good start. And the beauty about motor insurance is a 1-year contract. So it means you can start collecting the data you need today, provided you have the right people and you have the right technology. Thank you.
Thank you, Jackson. You also put it quite eloquently and well about the three foundation on people, technology, and process. I'd like to bring in Jay, especially on that that point from Jackson on people and pricing, just to understand from an actuary's perspective, what motor insurance pricing can be that would lead to be very customer centric, but also very sustainable for insurers in the industry. How can we go about that?
Yeah, thank you, Kevin. And I think a lot of, in fact, what I had in my notes have been very well captured by Jackson. I see Jackson is an actuary these days, and I believe all the actuaries in the room were really smiling and nodding their heads like me, yeah, as you spoke about it. And I think it really touches on that. I mean, for the longest time, I've been in the industry for over 15 years. We've been talking a lot about risk-based pricing, because the risk-based pricing is the foundation of fairness within the insurance sector, particularly in motor. Because the problem at the moment that I see within the motor insurance industry is a problem of trust. I was actually the first one to fill in the Menti, and my response was low customer trust. I see only 4 currently, but I feel the problems that we have at the moment is everyone feels ripped off, starting from the policyholders themselves, the insurers themselves, the intermediaries, the reinsurers feel the insurance companies are ripping them off. Even, people who are innocent bystanders, like pedestrians who are hit by vehicles, and they're having problems claiming on their, third-party liability, and it's taking a long time, and they also feel ripped off. So we live in a low-trust society, and for that to change, we need to ensure that, most importantly, the customers, because really the customer is king here. We need to ensure that they feel they're in control of, the insurance that they take, be it, and for this primarily through the premiums that they pay. Every time someone gets an accident, they see it as an opportunity for them to claim and maximize the claim that they make, because they feel they pay a lot of premium, but they don't get much in terms of benefits or value from the insurance sector. So the first point has to be that aspect of fairness. People who drive better need to pay less premium than people who, reckless drivers, People who have cars that are not roadworthy need to pay higher premiums than people whose cars are less roadworthy. So that has to be a fundamental change that has to happen. It has happened over the last 10, 15 years. In Kenya, we are really innovation friendly. And also over the last 10 years, there were comments around, innovation around technology, around processes like, for example, telematics, usage-based insurance. We've seen those being introduced over the last 10 years. We haven't seen a lot of traction, and there could be reasons to that, probably, that we'll cover as part of this webinar. But I think it's important that we bring in the customer to be the center of this, and to ensure that we solve the problems that the wider society faces as a result of being part of this, being in this mobility space. Starting from the premiums themselves, and even people who are not even policyholders, innocent bystanders. How do we ensure that they are also well covered as we provide insurance to the people? Thank you.
Thank you, Jay. You also put it very well, and has preempted what Sheila's question. That would be, how do we ensure that the innocent bystanders, that is the third parties, who are greatly affected by motor insurance accidents or motor accidents, how do we ensure that they get compensation? And what are the ideas you've seen across African markets? Sheila?
Okay, so fundamentally, Kevin, so thank you for the question. First of all, I'm enjoying the webinar, and I'm learning as I also respond to this. So I would say, firstly, my fellow panelists have talked a lot about property damage. So when a car gets damaged, but we haven't really talked about third parties, right? So I believe that everything that has been suggested so far can be done, right? Although maybe Kevin, I think as part of the questions, I have a question to my panelists in terms of telematics. I think most people are nervous about the privacy issue. You don't want somebody who's tracking you everywhere you go. So I don't know, maybe we can address that as one of the questions later. But I want to talk more about third party. And I really believe, Kevin, that the reason why our premiums are not sufficient to cover our costs as motor insurers is the fact that we have, now I'll go a bit technical. So if you're not an actuary, I'll try to simplify it. We have an asset liability mismatch, right? So one of the first lessons that we learn as actuaries is what we call the Reddington's principle, right? And it's about matching, that your cash flows are supposed to be matched. And so before we can even talk about pricing, our cash flows matched in the first place. And with motor insurance, especially when it comes to third-party injury, they are not. We receive our premiums within 1 year, but then claims, we are paying them 4, 5, 6, 7 years down the line. So fundamentally, there's a mismatch in terms of the timing of the premiums that we are receiving and even the amount, right? There's a mismatch between the premiums we're receiving and the liabilities that we're paying out. So how can you price a risk which is already mismatched, right? And so I think the first thing fundamentally we need to look at is separating those two risks. So I won't talk too much about the property damage claims because my panelists have already talked about it a lot. So I think we should separate how we price on damage claims and third-party property damage. We should separate that from injury. So either we separate the product or we maybe pool as an industry how we manage third-party claims. But the way it's being done currently, we receive premiums within 1 year and then we're paying claims over a long time, doesn't work. So what have I seen working in other countries? And you'll just allow me to share my screen. I'll just share a few slides. Right. So if you follow me on LinkedIn, you'll know that I speak very passionately about a concept called the Road Accident Fund. And I was very excited this year that Zimbabwe is actually implementing a road accident fund, and they're implementing it in exactly the same way I've been dreaming about. So Zimbabwe has made my dream come true. So before I go into Zim, I just want us to zoom out a little bit. We've talked the first, these 30 minutes that we've been in this webinar, we've talked a lot about our cars. But let's first zoom out and think about third parties, right? What happens to a third party when they get an accident? This story, I lifted it from a Zimbabwean newspaper, from Sarah Moyo. And this quote just touches my heart. We lost him and then we lost our home. What does she mean there? She lost her husband, but on top of losing her husband, she also lost her house, she lost her dignity. So that was because her husband, who was 35-year-old person, is at the prime of his life. He was hit by a speeding truck. He spent days in coma, meaning likely there were medical costs that they had to pay, and then finally he succumbed to his injuries. So she was left with overwhelming medical and funeral. So there's a medical bill, and you can imagine he was in a coma, right? So she was left with overwhelming medical bills and then also the funeral bill. And in the southern part of Africa, they're not like us. Their funerals are very expensive. So there's that. She was also left with no income to support the family. So already her income has been wiped out. The breadwinner has been wiped out. There's no more income to support her family. And in the end, she was forced to sell her home to pay those debts, right? And the government in Zimbabwe looked at this and they realized, you know what, thousands of Zimbabwean families are going through this. They're alone and unsupported when there's an accident, and it's not right. So with the road accident fund now that's being proposed in Zimbabwe, what it's going to make sure is that, number one, there's a rapid ambulance dispatch. So similar to what Mr. Wambogo was talking about, but now for third parties. As soon as the accident happens, the road accident fund sends an ambulance to take the person to the hospital. And they do this within what we call the golden hour. The golden hour is the 1 hour during which, if you can handle the person correctly, their injuries won't get worse. In other words, you can prevent somebody from becoming a quadriplegic and maybe only having lost 2 limbs, right? So a lot of why third-party accident victims suffer is because of how they're handled after the accident. Then also, the road accident fund does not pay cash. So this means that we are removing rogue, not all third-party lawyers, but we are removing the rogue third-party lawyers. Why? Because the medical bills are paid directly by the road accident fund to the public hospital. A funeral benefit would be provided to Sarah automatically. Loss of income would be covered for her, and it would be paid in an annuity form. Remember, I talked about asset liability matching. So the road accident fund would now be invested in long-term assets, and it would be able to pay annuity payments to people who have lost their income. And then, if you notice, what I said about this whole story is that I have not talked about a lawyer being involved, right? So that is the beauty here. There's no third party involved. The person gets the benefit directly. So the current gap that is there in Zimbabwe that they're trying to address, which is very similar to what we have in Kenya, is that there's no post-accident care that is available or a structured compensation. What happens is when there's an accident, what happens? They're called what? People of goodwill are the ones who help. They make the injuries worse, and so there's no structured compensation. And then also, even just by how we've, how we think about motor insurance, as the insurance industry, we only focus on the car, on the property damage, and not people. And then there's no coordinated trauma pathway or rehab pathway. And of course, we don't have a systemic way to cover medical income and survivors. So that is why now Zimbabwe has approved this year a road accident fund bill. And as I said, my dream has come true because they are doing it exactly the way I've been proposing. The funding will come primarily from motor insurance premiums as well as potential complementary sources. So what is most likely to happen is that motor insurers will cede the third-party premium to the road accident fund, and in exchange, the road accident fund takes care of the injury portion. Zimbabwe went benchmarking. They went benchmarking to their neighbor Namibia, and I work very closely with our Old Mutual Namibia business. So I can tell you, Jackson, my Old Mutual Namibia and the insurers in Namibia are not crying about loss ratios because they don't have to worry about injury, because property damage, you have much more control. So our peers in Namibia are not crying about loss ratios, right? Because the Namibia MVA fund takes care of third party. So a few success stories: the fund is solvent, less than 1% of costs are paid in legal settlements. And I know I'm taking time, so I'll just give two more countries. In South Africa, they have a road accident fund, but it's been having many challenges because of corruption as well as too much reliance on third-party lawyers. But there's an amendment that they've recently made. And with that amendment, they're proposing direct claims, which would be similar to what Namibia has. And then we have India as well. India last year, and in fact, it's Jay who told me about this. They were actually proposing to introduce cashless treatment for road accidents. So if you get what the theme is across all these, it's that the treatment is cashless, right? And it's done within the golden hour. And again, there's use of tech. And then lastly, even us as Kenya, we have tried doing something similar. We had a motor pool some years back that was mainly for PSV. However, it folded up. Why? Because it was not voluntary. So if we ever consider doing this in Kenya, maybe not in the short term, in a couple of years, the lesson learned is that it should be compulsory. And then we also tried a second one after this one folded up, a second motor PSV pool. What happened with that one? Because we haven't fixed the compensation structure, it went under. So in summary, Kevin, what I'm trying to say is that we cannot price motor properly if we have an asset liability mismatch. And the way we can fix that is to separate those two kind of claims, the property damage and the third party injury, like other countries have done successfully. And then whether the third party injury is managed through a pool or through something else, I think it's very untenable the way right now there's a mismatch. Again, I just like Mr. Wambogo, I'm passionate about this topic, so apologies for taking time.
Thank you, Sheila.
I actually wanted to comment if the moderator allows me.
Please go ahead.
Yeah, Sheila, as you were talking about that RAF in Zimbabwe, my mind was just going through SHA and what it means when something is led by government. it starts well, it ends badly. The reason because the motivation of those people in government is not always the same. So we've seen how much, for example, money has been looted from NHIF, from NSSF. There are people who have big estates in Kenya because of NSSF and the rest. And as soon as you put up South Africa and you said problem of corruption, I was like, okay, so my thinking was right. And I don't like to just talk about problems. I like to think about how do you solve it. And I was just thinking that because the premiums are actually being picked from a portion of the premiums collected by the insurance industry, this fund is a good idea. It should actually be run by the insurance industry. Because there should be a residual risk that if they don't run it well, then the claim goes to the insurance industry. So they will make sure it is run properly. So I think it's a very good idea, but I would never leave money that is contributed by wananchi to be left to be handled by government. That's my only contribution. And I think you've already indicated in South Africa, the solutions that they're proposing there, they will not work. In any case, once it's money that is easy and free. And the problem with government is that once something becomes a cash cow, it becomes very difficult to reform or to remove. It's actually amazing the government managed to actually create SHA away from NHIF. Hopefully, it's going to be better than NHIF. Thank you.
Thank you, James, and I totally agree. And it would be specific to specific countries. For example, in Rwanda, I think this could be run very, very well with the government. But as you're saying, not every country has the kind of structures that Rwanda does. So in Kenya, yes, I agree. It would be really good if the industry could run such a fund. The only problem would be that we would need to partner with government to change the compensation, because the aspect that actually removes fraud is the direct compensation to hospitals. So the compensation law, our compensation laws would have to be changed to allow for a completely different compensation structure. But 100% agree with you. The industry, depending on which country it is, and in a country like ours, definitely the industry would do a good job in running it.
By the way, and I'm sorry to, I wasn't saying it should not be voluntary for the industry to create it should be under the law. And I think that this is an idea, if it's anything that coming out of this webinar, is an idea that needs to be picked up. Jackson, the group CEO, is the chairman of ACI. Please, can we begin to have those conversations? This is a beautiful idea, it should not die.
Yeah, thank you, James. You told me to comment. Yeah, it's a good idea, and the way I look at these solutions, I break it apart and say what is it that is making it work. In this case, regardless of who runs it, whether it's government or it's private sector, the first thing is that there must be a structure around compensation. And I know for a long time, Kenya, if you looked at the ACI submissions to around the budget time, they would always try to advocate for structured compensation. What does it mean? Define what are the costs that are involved in compensating people. There will be the costs that lead to the injuries. There will be the certain costs around, and even that we need to have a way of making it predictable. There's a cost to remove judgment around it. There's a cost that drives, of course, the service providers involved, whether you're paying a hospital bill or whether you're paying a lawyer. Right now, the challenge we have, and I don't know from my observation in the industry, if you look at our third-party payouts by insurers, they actually have escalated a lot since 2017. And the main driver was, ironically, it was meant to be a good thing, to speed up the dispensation of justice to victims. Then previously, magistrates courts could only award up to about 400,000 shillings. Now that limit was raised to about 20 million shillings. Now, was the intention good? Yes, it was definitely good. But we Kenyans, being Kenyans, it created an avenue or a bigger avenue for judgment. So if you look at the consistency of that, judgments, for example, Jackson with a broken heart in court A with lawyer A will be paid very differently and maybe multiple times with the same Jackson with a broken heart with lawyer B in court B. So, and because of that judgment, now, if you introduce structured compensation, so into this fund, because that's really what makes it work, it will be very clear how much gets paid for this broken heart of Jackson, how much get paid if Jackson decided to use a lawyer. It should be fixed because, and I know, James, you did touch on fraud. One of the areas we've had of fraud, and I'm not afraid to say this, is where people even manufacture documents, or you have people where there are claims filed on their behalf, and I've had on several cases there with IFIU, where a lawyer wrote to an insurance company saying Joe Bloggs was injured in this accident, and you reach Joe Bloggs, they have no idea there was something like that happened. But someone went to a police station, read there would be, noticed there was an accident, and created documentation. And because this money is paid to the lawyer, and I'm not saying all lawyers are bad, it's a few minority, but those few are fleecing the whole industry, then they go and collect a lot of money, which they either never pass to the victim, or they don't know. And so there is no structure. The other thing that I remember the insurance industry had lobbied for was a two-check system. And it was part of that structured compensation, where if you're paying a lawyer and you're paying a victim, it's very clear how much is going to the victim. It actually goes in the victim's name, and how much is being paid to the lawyer for the legal services, because that is actually governed by, is it called advocates, the remuneration order. Unfortunately, for these third-party cases, that never works. So there is area, and I agree with you, Sheila, we need this fund, but we need to actually create the structures that actually make sure that that fund is successful. And the fund itself, I dare add, should not have KPIs around the experience, because again, it should also speed up the payments to the victims, because it's very important. Why do we have that party? Why is that party compulsory everywhere in the world? I think it's only 2 states in the US where it's not compulsory, and even in those states, there are certain requirements they have before you go without third-party insurance. It's because the intention is to protect the public, the majority who are innocent, from the impact of accidents, which they never planned for, and they will never be in a position to cover from. We don't want many moyos using your case, Sheila. Thank you.
So based on what, and thank you for that, Jackson, based on what James has said, I think we need to do a benchmarking study. A proper one, as maybe some of the key industry leaders, to go and see what happens in Namibia. Because remember, another benefit of a road accident fund is that motor insurance just focus on property damage. Mutual Namibia was voted last year, the previous year, as the most customer-centric insurer. And I work with them very well. Can you imagine, the only thing you have to think about is own damage claims and third-party property damage. Your only stakeholders is garages, right? So maybe, just the first thing we need to do is to see this actually in action in Namibia. And maybe that's a conversation that I can continue with you offline, Jackson, on let's go and see. We might not implement necessarily a road accident fund, but there might be some things we learn that we can bring back. Sorry, Kevin, for taking over. Taking over your webinar.
It's okay, Sheila, and I personally enjoy how passionately you three have discussed on the fund and the possible solution for the motor industry. Maybe to bring Jay back into the conversation, as a way of building trust, I think the motor industry relies on several other parties. That is brokers, that is reinsurers, agents. Just maybe you can talk about if the prices or the costs brought out from these other parties really value for money for motor insurers.
Thank you, Kevin. And as I mentioned earlier when I started, of course, the motor insurance value chain has many stakeholders, many partners. As I mentioned also earlier, all of them somewhat feel shortchanged. But even then, the current structure within the motor insurance industry is not conducive for sustainability. Yeah, a lot of the partners within this whole value chain are either how they are remunerated or compensated is not on the basis of risk. Underwriters are remunerated on the basis of risk, the others are not. It's either on the basis of a flat amount in the event of maybe assessors, when you send assessors to go and assess, or even valuers is based on a flat amount. Lawyers, the longer a case takes in court, the more money they make. For intermediaries as well, it's on volumes and making as much out of that. There is no incentive to ensure that this quality business that then comes in. It then means that for the motor industry to be sustainable going forward, it then means all these partners have to be aligned in terms of interest. Yeah. Of course, I forgot to mention also reinsurers on one hand. Of course, reinsurers play a very big role. Of course, from a reinsurance perspective, typically you'd expect them to then come in to cover you against sort of your large risk or your catastrophic risks. The nature of motor insurance is very different. It's a lot more high frequency, low severity. Their pricing structures may not allow for that, given that mostly it's excess of loss type of reinsurance that then comes in. So it then means, across all this, you need to ensure that, all those interests are aligned. We need to ensure that we remunerate them on the basis to ensure that we all get the same outcome in terms of the claims performance and overall sustainability of the industry. For the assessors, for example, it needs to be on the basis of the performance of essentially what they do, not just on the number of assessments that they do. For example, how we need to remunerate better people who identify loss, fraud, from that assessment perspective. For the lawyers that you work with, people who expedite cases faster, for the intermediaries that you work with, the quality of the business that they bring in, and these are the people that you can now use to influence that improvement of trust that we need from our customers in the industry. Thank you.
Thank you, Jay. I think you captured it also well, that we need to be aligned as an industry with all the stakeholders that are in play. So maybe I'll ask Jackson, given what the MP was proposing last year of making that party optional, how would insurers position themselves to better serve if that was the case, that party motor insurance was optional?
Yeah, that's a very interesting question, and I think it was MP for Langata, Jalango, who came up with this. And the question that went through my mind then first was he talking as a motorist who is thinks that the insurance premiums are too high? Because actually he didn't say that party. He said insurance should be optional. So I'm not sure whether he understood what he was talking about, or whether he was talking as a representative of the people. Why am I saying that? If you look at the data on the NTSA website over the last 5 years, and maybe let me talk about the last 4 years, exclude 2020, 2021 because of COVID. We have about 20,000 accidents every year. Yeah. Out of those accidents, an average of about 5,000 or 4,500 deaths every year from accidents, and an average of about 12,000 minor and serious injuries. This is real data from NTSA. Now, majority of the people who get injured are not motorists. They are pedestrians, that's the highest number, followed by passengers, and then motorcyclists. Those are the people who get affected by accidents. So I can almost say without fear of contradiction, the people who bear the brunt of motor vehicle accidents in our country are actually not the motorists, it's actually the third parties. And this picture is reflected all over the world, which means there has to be a way of protecting these third parties from becoming the example we were given by Sheila, called Moyo. It then goes to, why do we have insurance as motorists? Two things. One, accidents by their very nature are never planned. And when they happen, you don't even know the severity and therefore the costs and the consequences. So that part insurance why it's compulsory all over the world is actually to address that. So as I said, from what I've tried to research all over the world, I think it's only 2 states in the US where it's optional, and even in those 2 states, there is certain things you're required to do. I think in Virginia, you must pay $500 per year into a government fund, and for you not to take that party insurance. And even when you pay that, you are still responsible to pay for the consequences of your actions should an accident happen. So that is almost government keeping some money in case you misbehave. And you can imagine $500 is not small money. I think in Philadelphia, you are required to demonstrate means to pay. Why do they require that? Because no motorist, I don't believe any sane motorist goes around looking to have an accident. So you might be even the wealthiest person around, but the day the accident happens and the kind of damage you cause, you'll not be able to compensate either in the amount or at that point. So that party insurance is actually meant to protect these victims who we know for our country and most of the world are innocent from the consequence of these unplanned events. Now, which brings me then to what should the insurers do? One, I believe as insurers, now speaking as an industry player, we need to be quicker and more fair in paying for genuine accidents. We do understand the issue with fraud because unfortunately, given the country we live in, you have a lot of fraudsters trying to take advantage. But we need to have ways, and just to touch on them, of quickly identifying the innocent victims who are just to be paid and paying them quickly so that they get back onto their feet. The process that I think Sheila was taking us through is one such solution where you use a structured compensation in a fund, and that is done quickly and fairly. So to me, I don't see that party insurance as protecting the motorist who is driving the car. Yes, it protects them from, because otherwise it will be paid out of their pocket. But more importantly, they are unable to pay and they are declared bankrupt. You still have a family like Moyos who have lost a loved one, someone whose property is damaged, and that must be compensated by insurance today. So I don't see a scenario where one can say you do not need insurance, as Delango said, because as you said, what is compulsory in Kenya is that party. He talked about insurance, and that Kenyans don't buy that party insurance, which means even people themselves are aware that their own vehicle, if it has an accident, their ability to repair it at that point is not always guaranteed, depending on the timing or the extent of the injury. So I know I've given you a bit of a mouthful, but I think for me it's about the service on the third party and making sure that commitment that we make to the motorist is actually fulfilled in a fair, just, and efficient way when that accident happens. Thank you.
Thank you, Jackson. Adding to what Jackson has mentioned on positioning and paying genuine claims faster, just want to bring James in and ask whether a solution where we can pay insurance on a by use basis, similar to what we see in travel and in other classes, is that a viable solution as opposed to just a compulsory third party that goes on for a full year?
So I think I don't know. I think Chira is the one who actually said, this thing called telematics. There's a challenge about it, because to insure a vehicle on the basis of use, then you have to have a way in which you're able to tell the vehicle is being used. If you can find technology that ensures that, well, you're not tracking someone, but you can tell the vehicle is being used, which is mileage and the rest. Indeed, it is possible, because if I have 4 cars and you insure me, the challenge we have here, we have just a generalized average insurance in Kenya. So you insure me, my son drives, my daughter drives, my wife drives, anyone drives. Now, if you insure me, my car together with a driver, so that if I need to add my daughter, I add a premium for it. That way, for the people who say, I'm the only one who drives this car, then you can actually use, for example, mileage or whatever else without necessarily going to telematics. Those who would be agreeable to telematics and tracking devices would be okay. It would be very easy to implement. But for this other one, you just have a situation where you say, okay, so it is so much premium per kilometer driven. Let's verify your mileage. Now, the problem in Kenya, of course, we have this whole thing of fraud, people taking advantage. Some people will want to ensure that. So you also have to do some risk profiling to know who can qualify for this and who doesn't. So if people just sat down and thought through it, it would make a lot of choice. I mean, a lot of sense. And I want to remember a gentleman who he's late, the late Chris Kirubi. As you would imagine, he had a lot of cars, and he's the one who always used to complain. And he would tell me, "Look, I got so many cars, I can only drive one at a time. Why am I paying 4% for each of those cars? Yet I should pay 4% for the combined 4 cars because no one else drives those cars." Now, the reason why people then don't want to have that conversation is because of something I think Jay said, that we're not being fair. You want the guys who, if you can capture, if you make it, you just have to insure 4%. You collect enough premium knowing that guy, his premium will be way more than the risk that you're covering. Then there's another guy who is doing a mirror business with the ProBook he has insured or some other business, and he's paying the same 4%. Now, you see, you are subsidizing this guy with 4 cars is subsidizing the guy with the Pro Box. But if we bring in the risk profiling that Jackson talked about, you will be able to collect the right premium from the Pro Box, and most likely the Pro Box will say, I don't want comprehensive insurance because it would be too expensive. Or someone who's just got a driving license yesterday, it would be too expensive for them. I mean, try for those, if you happen to go and want to buy and drive a car, say in the UK, and you're a young driver like a student, there's so many of them whose insurance is more expensive than the car they have bought per year. So I think the bottom line should be, first of all, have the courage to say, let's ensure what risk people are bringing to us. So even if the total premium shrinks, the likelihood of claims reduces, your claims ratio basically reduces, and you're able to make a profit. And then you can begin to grow from there. So I think it is possible. Unfortunately, it would require a company that is willing to bite the bullet, have maybe their business shrink a bit, but from that moment, the way that business will grow will be significant. In fact, if there's anyone here from AR Insurance, since they are starting motor insurance, I would advise them, please start with something like that, even if you're doing the other average kind of insurance. That way, what you are really recommending can work.
Thank you, James. Jay, do you have something to add?
Yes. Maybe if I can add on to what James said. Usage-based insurance hasn't seen a lot of traction over the last 10 or so years since they were introduced, either through telematics. I saw an underwriter introducing pay per mile or per kilometer. It hasn't really worked, but I still feel there are use cases, very good use cases for that. Yeah, I think someone also mentioned earlier, we are largely a gig economy at the moment. People can't even afford to pay a full annual premium. In fact, I think the industry is sort of now moving slowly to sort of introducing some sort of monthly payment options that are outside IPF, and usage-based insurance can be a good place for this. Of course, as Sheila mentioned earlier, privacy concerns are big, especially when you talk about telematics, either by using a device or using your phone. But at least, people share their information a lot online these days. You can imagine all that you share through social media, even when you go on Ubers, ride hailing and the like, and probably even from an industry, we have to be then creative in terms of how we then introduce this. Yeah, a good place would be, these ride-hailing taxi drivers, they are struggling in terms of cash flow. They're living day to day. It would be a good prospect for them. And then you can then have, for example, the customer, the rider who is in that car, give a rating in terms of how safe that car was, so that in a way, you know, the person will then pay premium as long as the ride is on. Through that process, you're getting feedback on how he's driving that car through the safety rating. And, you know, through this, I know insurers are already working with the likes of Uber, Little, and the others to offer embed hospital cash and other types of insurances. There's a way in which you can now offer motor vehicle insurance in there. So I see that as an area of innovation going forward. And again, as James said, it's really to challenge, you know, the underwriters to, you know, open this blank, you know, page and start rewriting how we do insurance in Kenya. Thank you.
Okay, thank you, Jay. Sheila?
So, Kevin, I just wanted to say, I think Jay is very spot on. And to add to what he said, we need to be innovative and also customer-centric. And customer-centric, sometimes we use it as a buzzword, but I'm going to use it in the sense of we need to do what we call customer journey mapping. So we need to understand what is the journey of a customer of motor insurance from when they buy the car until, you know, when maybe they buy another one. I'll give an example. I recently relocated back to Kenya from Rwanda, right? And so I had to buy a car. And the person who sold me the car also sold me that gadget where this is the way they explained about the gadget. This gadget, if you take it, it means that if you ever have an accident, you don't have to start disputing with the insurer on what happened during the accident, because literally it's constantly taking a video of your car. I'm sure you know what I'm talking about. I'm sure
Dashcam. You're talking about dashcam.
A dash cam, yes, a dash cam. Now you see, me, imagine I'm in insurance and I didn't even know a dash cam, right? But the way he explained it to me, I was like, oh, so if I get an accident, there's nothing to argue about with the insurer. It's all there on the video. Why wouldn't I buy such a thing? And you see, this person is finding me at the point where I am already removing cash for a car. What is an extra couple of thousands to buy the dash cam? So I think we also need to start asking ourselves, where are our customers, right? So if we know that at the time when they are removing money for the car is a good time for them to also remove money for a gadget that will be used for usage-based insurance, why are we not there? Another place where we all go to is where? The garage. Right? How much time do we spend at the garage? How much time do we spend in traffic? So I think as insurance companies, we need to ask ourselves, where do our customers spend their time? And then in what way can we somehow weave ourselves into their life and also convince them that these are kind of the things that would help them. And then I like what Jay said about stakeholders. All the stakeholders need to be aligned. Do our brokers and our agents even believe in these products that we are selling, right? So you can imagine if we know the customer journey. The other day, okay, I've been in Kenya for 2 months now, so I'm getting excited by small things. My bank gave me a voucher for Naivas because I used my card for shopping on a big purchase. Let me tell you, I am not going shopping anywhere else. I'm not going to go to Naivas. But what has my bank done? They are now, both my bank and Naivas are benefiting because they are fitting themselves into my lifestyle, right? In fact, that shopping voucher, I may not have spent it, but I'll be like, hey, I have a car voucher here, let me go and spend it. So I think even as we talk about innovation, right, we also need to add in the conversation of where are our customers, what are they doing, where can we get them, and how can we convince them that this product can benefit them. Thanks.
If I may come in, Kevin, here, and because it's important, it's an area I have really tried to mull over. Why is usage-based insurance? Why is telematics not working in Kenya? And I tried to do a bit of research of why is it more successful. And the top 4 countries in the world are Italy, where the prevalence is actually 70%. I think then you have UK, US, and then Canada. So UK and the US are about roughly 50 to 20%. Canada is about 10 to 15%. The rest of us are novices. Kenya features there. They don't even know the percentage. Now, and I try to then to understand why is it successful in these countries, and then why is it not working in Kenya? And there are actually two major drivers. One is the culture and acceptance within the country. But surprisingly for Italy specifically, the main driver is insurance premiums are very expensive. So the high cost makes them unaffordable, and therefore people accepted usage based because then you can limit how much you pay. Then I go to UK, which I think is the second country before US. It's the reason there are 20% is because of young drivers. Young drivers under 25 account 50% of those. Again, are on usage-based insurance. And what's the driver again? The cost of insurance for young drivers in the UK is prohibitive. US is a big market because it's a big market anyway, and culturally it started to gain acceptance. So it's a large market in terms of the number of motor vehicles. But yes, with a good proportion, and culturally it's becoming acceptable. What is the point I'm trying to drive home? The reason we in Kenya struggle trying to roll out usage-based insurance telematics is one, whether you are a good or a bad driver, given our very nascent pricing and your pricing at a loss as an industry, we are already paying the most affordable premiums, particularly for noted drivers. In fact, if anything, all the bad drivers are being subsidized by everyone else. So when you try to roll out a usage-based insurance, reward people based on how they drive or where they drive or whatever, you don't really have a value proposition. Even if you try to give that gift voucher, it will not be able to accommodate, because the bad drivers, I'll enjoy this flexible rate, they just move to the next whatever, they move to the next insurer. So I think the first step for me, for us to start changing, is actually for us to include more data points. So it will start becoming viable when you actually start making money, ironically, from motor, because that's when you say we are starting to price our motor business as an industry in a way that is sustainable. Right now, it's not sustainable for any of us. So the moment majority of us start making money from motor, it will mean as an industry we are starting to punish the fraudsters, you're starting to punish people who drive badly. Then after that, then you can now start saying, let me lower the price for the good people. But as long as, if I was to look at the insurance industry in Kenya as a pool, as long as when all underwriters are put together, even that guy who caused a major accident last week will still get their 4% or 5%, then we are going to fight this battle for a while. That's actually my perspective on why usage-based insurance is struggling in Kenya. Thank you.
Thank you, Jackson. I have a follow-up question for you. So there is the major thought under insurance of pooling of risk. It's what we study in school. It's what we are calling bad drivers are compensated by good drivers. I think even in the medical insurance, the sick are paid for by the healthier. So by adding these many data points and reducing the size of that pool, don't you think it will lead to a higher costs for everyone?
That's a very good question, Kevin. But my perspective is very, very important. Even on the pool risks, the price that the people in this pool pay must be sufficient to pay for all the claims in that pool. What you actually is called pure risk ratio. And of course, before you even add your commission ratio and expense ratio, the situation we are in Kenya is that as a pool, in that pool, it's not priced correctly. So how do you start raising the price paid by the pool? It's not raising the price for everyone. It's actually identifying the relevant additional data point to start profiling people who should be paying more. Why is everyone in the pool paying the same? So it doesn't mean everyone will have an accident. And I'm not calling everyone who has had an accident a bad driver, but there are people who frequently have accidents. There are people from a risk perspective who are more likely than not to have accidents. There are assets, if it's motor vehicles, because of their maintenance record, that are more likely than not to have accidents. There is locations where we drive, where because of the nature, the number of vehicles, the road conditions, we are more likely than not to have accidents. So all I'm saying is that as a pool, you need to pay a fair price. Today, the price we pay as a pool is not sustainable. So someone is having, so the motor insurance is being subsidized by other risks. So the principle of pooling is being applied, but if you remove all the other classes of business, all insurance will shut down. Because the premium, and we're all left doing motor, the premium we collect collectively is not enough to pay for the claims that we pay out. So I agree with you, but actually, if you now went and started doing that pricing correctly, there are people who will pay slightly less. Thank you.
Thank you, Jackson. I'm looking for some audience engagement. Don't see any questions on the Q&A box. So maybe you can give us concluding remarks on what are the immediate actions that underwriters can take. Oh, we have a question from Vice President. Please go ahead.
There's also another question on the chat box.
Okay.
Yeah, hi. So thank you. I think I've been following through. It's quite an engaging conversation. So I think I do hold some similar views and potentially divergent views on what has been discussed. The first one is perhaps, Jay, I know you sort of have a fisheye lens as a consultant looking at the experience for the motor book within the industry. So if say we were to look at every 100 shilling worth of premium that goes into motor coverage, if we look at the split between third party and comprehensive, what would you say is the utilization, or basically loss ratio, on that premium for a pure third party cover and a comprehensive cover?
Sorry, you mean within a comprehensive business, like the split between third party and
No.
property damage?
So if you are to look at the loss ratio for your third party book versus loss ratio for your comprehensive book, do you have any indication of what that is?
Yes, actually, that's a very good question, because at some point over the last 10 years, insurers had gotten to the point of reducing third-party premiums to the levels of 5,000 shillings, and we saw an increase in loss ratios during that time. Yeah, massive increase. Of course, that was also coupled with what Jackson mentioned earlier around the jurisdiction of the magistrate courts to award claims. And since then, we then saw tightening of the premium rates offered, or the premium amounts for third-party coverage. At the moment, they are still, even compared to comprehensive insurance, the loss ratios are actually higher on the third-party side, despite increase of the third-party premiums to around 10,000 on average on the motor private side. So I think the discussion that we're having here is very topical. The discussion particularly around structured settlements, the discussions around the motor vehicle road accident fund, they are indeed topical in terms of solving this in the long term.
Actually, if I may come
thanks.
in here, the loss ratio on that party is definitely over 100%.
Over 100%.
The last data I looked at is over 100. If you take just that party premium and the cost to the insurers, the last time I checked, it was closer to 120%. Of course, it does vary from insurer to insurer, but yes, so it is high. It's actually not. It's not a guesstimate. It's actually a proven hypothesis. I may not have checked the last 1 or 2 years. The last time I checked was over about 120%.
Okay, thanks. So tied to that, then my thinking is on third party claims, there can be a structured approach in terms of knowing what. My take and my understanding is that the headache for motor insurers is on sort of the repairing the vehicles on property damage, right? I hope that's a correct assumption.
No.
Not necessarily.
The biggest headache is actually that party.
Third party, okay.
Property damage comes second. So let me try and give you numbers on top of my head. When I look for every 100 shillings you pay out in claims, motor insurance claims, the cost of the material damage, including total losses, is about 75%. The cost of your services, expenses, whatever, it's about just at 5%. About 20% is actually the liability component. And that number has been growing. Previously, liability used to be closer to 10%, but it's been growing. So that should already tell you. So the area on average cost of claims, yes, it does affect some people in terms of the cost of material damage, but it's the easiest one to control. It's the easiest one to control. As an insurer, it's a no-brainer because it's about how you manage your service providers, and there is technology you can use to actually deal with that. The third party is where there's a lot of judgments, there's a lot of long tail, and that's why that's what really if you were to tell me the one bullet we need is what Sheila was talking about to fix motor industry in Kenya. The rest people can be left dealing with them in their respective entities.
Okay, thanks. So I think I tend to agree with what James was talking about in terms of decoupling third party and comprehensive, in the sense that the vehicle is an asset. You can view it as an asset or a tool of trade. So I will sort of look at motor insurance, the true motor insurance, being third party. And like you rightly mentioned, that's where the bulk of the claims are. Most of the victims are third parties, as it is. Now, it's drivers who normally commit accidents. And the mismatch that I see from a perspective is that insurance is tied to the vehicle rather than the owner, rather than the driver, and especially so when it comes to, PSV. So I think it might be important to start perhaps transitioning the conversation around as you renew your driver's license, you automatically purchase a third-party cover. So in essence, anyone who has a driving license has a third party. Now, if you commit an offense, if you commit an accident, then that ultimately builds up on your driving license, and then you can sort of charge differential rates every time someone is renewing their license. Then for the vehicle, basically you only need a sticker in that case on the vehicle, because all you need to do is to verify whether someone has a valid driving license. If so, then you'll automatically know that they've paid for some third-party insurance. Then tied to James's point, it doesn't matter how many vehicles you have. You can say that my risk appetite, say, is up to 1 million. So you can buy a cover worth 1 million to cover you for as many vehicles as you want. Or even if you have one vehicle, you may say, perhaps my risk appetite is only up to 100,000. If I get into an accident, I'm willing to take care of costs up to 100,000. Then you sort of buy a top-up cover over and above that. So, of course, it may require some legal or sort of changes to the Traffic Act, but me, I'll sort of position third-party insurance to rest squarely on the driving license rather than a stick on the vehicle.
But George, with that, so a PSV driver would have to pay third-party premium? His job is as a driver.
So my point is, it's drivers who cause accidents, and basically the liability, the onus should be on who was behind the wheel.
Yes, 100% agree.
They don't drive themselves.
So I agree with you. The question is, who will collect and who will make the payment? And I think that's what we are trying to deal with. I don't think we as insurers are stuck up that we must collect that party premium. The question is more for me. So let's go with your case. So the money is the DL. Who is going to do the compensation? Where will that money go?
Yeah, so remember, the point is, at the point in time
those would
when
be details. If I was to be asked, those would be details, because you find a practical way in which you deal with that, because I can see it working. I like that idea, by the way.
James, I'm with you, but it actually contradicts what you said earlier. The issue is it will go to government, because it's even easier.
No. Don't get me wrong. It won't go to government. So at the point in time when you're renewing,
let me give you a quicker solution to say who is on the road. Load it on fuel, like fuel maintenance levy. The question is not, I think, where the money, how you collect the money. To be honest, we will make it as part of fuel maintenance, because you don't move. Of course, now with electric vehicles, it might become more difficult. But previously, when all the vehicles were moving on fossil fuels, I would just say another X shillings of fuel levy goes into a fund for that party insurance. So that's the way I would deal with it. Although that is
Insurance,
Yeah. So
James,
James, if I may,
yes.
Yes,
so
please, yeah.
if I may, the point is, you see, it also boils down to human behavior. You say, if I'm renewing my license and I automatically know I pay insurance for it, and the amount of insurance I pay is also tied to my driving history. Now, ultimately, you'll make sure that everyone who gets behind the wheel has a valid insurance. So what happens right now, especially if you wanted to control the behavior in the PSV space, is you have someone, getting behind a wheel, cause an accident, jumps off, goes to another circle. So you're really not controlling behavior. Now, on the point of collection, when you're renewing your license, it can be configured in a way that you say you choose your preferred insurance provider. So you'll go pick, but again, if that is standardized, then again, still premium will go to the insurance provider. What I'm trying to address is also that behavior, and ultimately then tie in with the claims.
Yeah,
James, I don't know if
thank you, Vice President. That's what I was telling Jackson, that what you do is, and you've done it very well. Now we have technology. When you're renewing your driving license, you will have to put the code for your insurance, which can be run, the way Aki has integrated Moto, so that only then can the driving license be renewed. And then what will happen is when the police see you, they don't need to start looking at the windscreen anymore, which I really hate. They just ask you, what's your driving license? And then they check and say, this guy is insured. Now, for PSVs, you might have a second layer because of the size of the risk that the vehicle itself should also take care of third party. But the driver takes primary responsibility. Okay, this will be my closing remarks. When we get there, I'll come back to it. Or can we, you said we do closing remarks, but I thought there was someone else who had something to say.
Okay, thank you, James. Well, we have a couple of questions. Maybe you can pick up one, and then Jay, okay, you can pick up the second one. So the first question is on whether insurers have the spine to mark up their premiums. The risk is huge, but no one wants to increase their premiums because of, obviously, the unfair competition and the undercutting. Do you have a response to this, James?
Oh, yes. It requires someone who has belief. And I can relate to many times, maybe at UAP, we just decided this is how we're going to do it. It makes sense, it's reasonable. And then we put it in place. For example, we said you have to have your car valued. If it's not valued, then cover is third party. It's now standard, but it required spine to do that. Now, I feel that what would happen today if you decided to implement a purely profiling, proper risk profiling, it is very possible that 1 year, 2 year, your premium will go down. But the moment people realize, because now you have profile people, you segmented, you only got credible people who at the point of claim you can be very fast, the customer's experience will draw many others to you. Your claim ratio will be way down. So your premium, you might be writing 2 billion shillings of premium today, then it comes to 1.5. But if your claims ratio is 50, again, it's 75, 80% with a 1.5 and 2 billion, you can clearly see the mathematics. All it requires is someone willing to bite the bullet. You could make a mistake and suffer a little bit, but once you believe in something, implement it. Indirectly, you will start a wave that will eventually infect the entire industry. Today, we don't need ACI or IRA to come and impose proper risk profiling. We just need 1 or 2 or 3 courageous CEOs in the industry who decide this is what we are going to do, get their board to agree with them, start doing it. The results will speak for themselves, and everyone else will be like, okay, fine, now all of us have to do this. Today, I mean, there's a time if you told an agent or a broker you must take your car for valuation. They say, okay, we got alternatives. Do they have alternatives today? So it's just courage and be convicted. You know, if you're convinced, the problem many times is people don't like hard work. If you're not ready to do hard work, especially the guys who are the top, who are leading, I'm giving a challenge. Okay, Jackson's already moved beyond that. The others I can see in the panel, like James Mbithi, that's their challenge. Be the agents that are going to change the industry today, because you will have made a huge impact improving our society. And you create this situation where people begin to take responsibility for their bad behavior, for their, if, those that are bad start beginning to suffer for the consequences of their choices. Look at how people are driving on our Kenyan roads. You see, sometimes I see people cut in front of everyone, and I'm just like, I no longer want to drive in Kenya because of this sort of things. The moment you implement things like those, you will slowly begin to realize people take responsibility. People go and knock, I don't know, street lights. They knock off barriers on the road. They don't have any consequences. I just wish I was the head of the police, or, this would actually have to end and change.
Okay, thank you, James.
So maybe just to add on to that, to answer that question, in simple forms, I'm an industry player. A number of us have already beaten the bullet. I can tell you at Britam, we no longer have a rate for motor. You ask me my rate for motor, I can't answer that question. I use risk profiling, and those are decisions. And I know I'm not the only one. There's quite a number of insurers. So the landscape has started changing. I don't think the philosophy of a number of insurers today is compete on price. No. I think there are people
Jackson,
who actually say what enough is enough.
Yeah, people can look at the Britam numbers, because of course I know them by association. Is that our motor book has shrunk a bit and it has started growing now. Watch the space. I'm sorry, I'm not advertising Britam, but it is important for people to be courageous.
No, there is, so the data, we have actuaries on this call. So if you look at IRA website, you'll actually see who has been doing what. It's obvious that we are no longer where we were 5 years ago on motor pricing.
Thank you, James and Jackson. Maybe Jay, you can answer the question on the product differentiation among insurers, given you're an actuary and you do some product design and pricing.
Yes. And maybe just speak on to what James and Jackson have mentioned. You see, as it is right now, because we are evaluating this product on the basis of price. It's become commoditized. Yeah, everyone is looking at the price, and they're talking about the price. They're talking about the rate. The first thing you sell motor insurance, they ask you about the rate. We need to, as Jackson said, we need to move away from that totally. Yeah, there should be no linkage between a rate and sum insured, as it happens in other countries. That can offer opportunity for also insurance companies to, because the motor insurance industry is very tight. Margins are very tight. It's a commoditized business. Customers also need to see value. What Sheila also mentioning earlier in terms of, there are things that as a customer, I get delighted in terms of value, prompt claims payments, feeling that you're meeting my needs. I feel that's where the industry needs to move to. Unfortunately, to a large extent, it has been constrained again by capacity, resources, and that should come out if we just make the right decisions, bite the bullets, and ensure that we weed out, fraud, high risk, to ensure that we price those correctly, so that we ensure that we are indeed responsive to the needs of the market. Thank you.
Thank you, Jay. I'd like to bring in Sheila. What do you have to add to that?
So to this conversation, I want to say I work with 7 countries, and I can confirm exactly what James said. Among the countries I work with, the countries who decide to take the bullet, it's always the same pattern. premiums show a dip, and then they start becoming more profitable and even growing. And the reason now they start growing is because now they have good customers who are paying proper premiums. So, you know, this pattern that James has talked about, it's not even just in Kenya, it's a Africa-wide thing, probably a worldwide thing. When you decide to bite the bullet, temporarily there'll be some pressure on your top line, but it always pays off. So just to confirm, you know, it works. Biting the bullet, it pays off.
And maybe a comment, guys, on top line, the so-called top line. And I'm happy I'm talking to actuaries. Remember, even in IFRS 17, we no longer look at the top line. I think insurance industry is the only industry where when we release our results, we start talking about gross premiums. To be honest, as an investor, they do not care. Look at our cousins, the banks. When they declare their results, what do you see the headline? X bank declares X billions in profits. So we are the only ones who try, and our investors, our shareholders have been struggling because the value we purportedly create, one, we are annoying customers because we don't even collect enough money, so we are not paying claims on time. We annoy our shareholders, who are the people who put money in the business, they're not getting a return. And even us as the people running these businesses, you are frustrated. So I think we need to kill this obsession with top line and go back to value. One, first value for the customer. Are we fulfilling our promise? Secondly, value for the investors and the staff, the industry insiders. Are they getting their fair compensation for the work they do? So I think my urge to all of us is, I don't think GWP, it only exists in our head. Is it irrelevant? How come I don't see people saying KCB's customer deposits? That's not the headline, are now X trillion. So they issued Y in loans, or Standard Chartered issued, I don't know, X in loans, or Equity issued X in, or collected X in customer deposits. It's normally the profit. So I think it's a mindset change that we need as industry players when you look at our businesses. It's about sustainability, and you can't be sustainable if you are losing money every time, you're annoying your customers every time.
Kevin, I just have to chip in there. I didn't put my hand up, but I just have to chip in there because I have a short story about a client I worked with when I was a consultant in Rwanda. And that was the advice that I gave them. I looked at their book and everything, and through reserving can tell us a lot. And I was able to convince the MD, just focus on paying claims very quickly because they do PSV. And so there was also a lot of fraud there. So I just told him to focus on that, pay claims very quickly and price properly. And right now, they're actually at the top of the industry right now. By the time I did the turnaround strategy, that was 2017, they were almost insolvent, but now they're among the top industry players. So I think there's that decision, yes, on pricing, but also in terms of being obsessed with paying claims as quickly as possible. And I remember the last time I was actually with him, he very proudly took me to his claims department and showed me, Sheila, look, there's nobody waiting. There's nobody waiting for a claim to be paid, because for us, by that, like, you don't even have to come to us. We'll have already come to you and we pay you. Right? So there's a pricing, and also that obsession. We need to start becoming obsessed with paying claims. That people look at that company right now and they're like, wow, they come up with different reasons for how they turned around. But me, I know they just got obsessed with paying claims quickly. So, all these things, I think we know them, but we just now need to maybe hear more success stories to know. We need to actually just do the right thing that we know.
Okay. So Sheila, there is a question on the chat box that marries to what your last comment on the PSV. The question is on why the underwriters of PSV are going under in very huge numbers. What are your thoughts on this?
Hey, how much time do you have? I worked for a PSV insurer very early in my career. And I can tell you the thing that makes PSV players go under is what Jay talked about. The stakeholders in PSV insurance are working in opposite directions. You have rogue third-party lawyers. I even remember some of their names because we used to do a lot of analysis. You have rogue third-party lawyers whose business it is from morning to evening, it is to look for third-party accident victims and either fake claims or inflate the claims. That is literally all they're trying to do. So of course, if you have these rogue people all over the country, and from morning to evening, what they're thinking is, how can I make more money from you? Of course, you're going to go under, because you see, unlike Jackson, a PSV insurer, you can have 20, 30 claims from one vehicle, one incident. So I remember, in fact, when I was working in that company, we had a WhatsApp group for accidents in the country. We used to get heart attacks every day. You see an accident and you know that was our vehicle, Kuisha. You know, so that I would say that is the main reason why PSV insurance tend to go down, because literally you have and I'll just say it plainly, you have a very rogue legal you have rogue legal stakeholders whose business it is to actually make them go down. It's as simple as that.
Okay. James, do you have anything to add to this?
Not really. I think it's been dealt with adequately.
Oh, perfect. So I think we can move on to closing remarks. I think it has been quite an insightful session. Just maybe from the panelists, as we close, I would like to understand what's your key takeaway that you'll give attendees to practice on their underwriting business, especially for the motor class. You can go with Jay first.
I think for me, my parting shot, and just picking up to what James mentioned earlier, I mean, for the industry to be sustainable, we need things to work. We need systems to work. It's beyond, some of these actions are even beyond the insurance industry, if I may say so. And that's why I really applaud, for example, the policy working party of Task for organizing this, because there are policy issues, areas around enforcement, basic enforcement of traffic rules. Yeah, ensuring that the roads are, done well. Markings are done well, lighting, borders obey traffic rules. It has to come to that. So I think my parting shot is, even as industry practitioners, we need to do more beyond what we're doing. Yeah, the actuaries in the room, just sitting down and calculating, doing your math, as underwriters in the room, just sitting there and waiting for business and trying to manage the business that you've written. Let's take it to that next level. Thank you.
Thank you, Jay. Sheila, what's your parting shot on this?
My parting shot would be, let us remember we are Africans, right? And the one common theme, as I told you, Kevin, I work with very many countries, so I travel quite a bit and I talk to different countries. And the one thing I've noticed we have in common is Ubuntu. Ubuntu is a philosophy that says that if I suffer, if I suffer, you suffer. If you suffer, I suffer. It's an African way of caring each other. And that's how we used to care for each other. It's how we've always cared for each other. If you look at even how we invest, that's why we have chamas, that's why we have circles. We are people who believe that if we come together, we can do a lot. And so my parting shot would be, even if we don't set up a road accident fund, what can we do together? What are some of the solutions that we've talked about are things that, we've already achieved together a lot together as an industry, right? To get where we are. Let's start thinking about some of the things that can be dial shifters, which we can come together as an industry to do to make motor insurance profitable. Of course, I champion a road accident fund, but I'm sure there's so many other ideas that we can think about if we came together and address this problem. Thank you, Kevin. This was very enjoyable. And you've led the discussion very well. Thanks.
Thank you, Sheila. So, James, you had preempted that you have some important thing to say as your final message.
Yes, number one, I think I'll start with the word courage. Courage. You guys, those who are on the trenches, courage. You need to believe in something and start doing it, and the results will come. Be the agents of change, and even those who have logged in, I'm sure some of them are involved. So that's number one. Number two, I feel and congratulations to Task for organizing this. And we probably need a lot more, and maybe the audience be even wider. But I would say that in today's conversations, a few ideas have come out that are actually quite good. One has actually come from the audience, the one of insuring the driver, and also Sheila's idea of road accident fund. I think we need to pick them up and find a way in which we begin to have conversation, refine these ideas. You notice, I mean, just that conversation about insuring the driver, we could have ended up where Jackson said it won't work. But we, by just discussing it further, we'll find practical ways in which this happens. Then what then happens, the industry can go as one and simply say, let's do this. So those two things, first of all, courage to try what will work for your company would move the industry forward. Number two, what we need to work jointly on the basis of what Sheila has talked about will move us even further. We have an industry, the industry in Kenya, I have to say, we beat ourselves, yes, but we are a fairly advanced insurance industry compared to the rest of Africa. However, I don't think it's good to compare ourselves with the dwarves. It's good to compare ourselves with the aspirations of where we would want to be. And I don't think that our comparison should be against developed market because they have a different way of life. We need to look at what would we like to see, and then we begin to work towards there. Honestly, I think the last, should I say 15 years, there's been quite a significant movement in the industry. It slowed down in the last few years. I think we can pick up the pace again and then get somewhere, especially given the fact that now we're having technologies, we're having capabilities that would not have been there 15 years ago.
Thank you, James. Now I'd like to bring in Jackson for your closing remarks.
Yeah, I think James has said quite a bit of what I wanted to say, but I think there are two takeaways for me. One, we need to just do it. What do I mean? The world is never perfect. So continuous improvement is important. So there are several things we discussed today. Let's start doing them. Around the data, the first question you asked, start with the data you have, do incremental improvements. Don't wait for it to be perfect, because I think that's how we roll. But most importantly, for all of us as industry players, I think we need to collaborate more. Whether it's within the companies we work in. Jay said I'm not an actuary, I'm an accountant by training, but I collaborate a lot with actuaries until I had to learn. And Jay, they used to work with Jay. So I had to ask him, what is it that you do, until I learned. And so within the companies we work with or we consult for, let's collaborate. But also as an industry, the challenges we face, I say we may be competitors sometimes, but none of us is gaining by us competing to being defrauded. So there's room for us to collaborate. There's room for us, and we try to create several platforms. At Aki, we have EMIDS and DIMVIC database. DIMVIC, everyone applies. If you look at the data we exchange on EMIDS, the Integrated Motor Insurance Database, which would help us deal with some of these issues of fraud. Not everyone shares the right data. So, and you're wondering, you don't benefit by your competitor getting defrauded. So just being action people, using as many data points as we can, we're going to get better. We collaborate on dealing with, I like the whole issue around compensation fund that Sheila brought out. Let's pick it and actually collaborate and do it. We don't need to wait for government. In fact, in Kenya, private sector moves before government. Let them decide when we solved this problem. And I don't think we can just sit back and work it out. So that's my closing remarks. Let's collaborate and let's just do it. Thank you.
Thank you, Jackson, and thank you to the panelists as a whole. I think this discussion has been quite insightful and quite needed and quite timely. So I think for people who are in the industry, I think the key takeaways from all the panelists is that we just need to do it, take up courage and bite the bullet, and finally more collaboration. The webinar has been organized through TASK, through the policy working party for public policy, headed by Sheila herself. So we can have a round of applause for Sheila. and her and her good team who has organized the webinar. So with that, I think we can end the meeting. We can end the webinar. Hopefully, I've not left out anything. Catherine, you had something?
Thank you, Kevin. Thank you, Jay. Thank you, Sheila, Jackson, and James. Sheila, thank you very much for organizing this. If you want to hear more of this, there is more in Diani with the Public Policy Working Party, courtesy of Sheila. You're all welcome to the convention. Have a good evening.
Thank you. Do have
Thank
a lovely
you.
evening, everyone.
Thank you. Thank you.
Great evening,
Thank you.
everyone. Bye-bye.
Bye.